You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello and welcome to The Investor Way with myself, John McEwen, my co-host Sam Ball. This week on The Investor Way, we have Persimmon, Aviva, Admiral Group, Diversified Energy Company, TUI, and our US company of the week is PayPal. Shall I kick us off with one of the favourite house builders of the show?
I think they're all favourite house builders on the show.
And I've owned just about all of them. But yeah, no, I have had Persimmon in the past. They had their half-year results out with half-year revenue rising by 14% to £1.5 billion, driven by a 4% rise in new home completions and 8% higher average prices. The private order book rose by 11% to £1.3 billion, and underlying pre-tax profit grew 11% to £165 million ahead of market expectations. This was helped by a revenue uplift and a tight grip on costs. There was a free cash outflow of £132 million over the half and net cash position of £109 million at the period end. An interim dividend of 20 pence per share was announced in line with the prior year. For the full year 2025, completions are on track to rise to the 11,000 to 11,500 range, and market forecasts point towards pre-tax profit of £432 million, which is up 9%. For 2026, completions are expected to be around 12,000 units with good profit growth, and the shares were down nearly 2.5% in early trading. In terms of valuation, Persimmon has a market cap of £3.3 billion, and trades at a forward price to book of 0.99 with a 10-year average of 1.92, and it has a prospective dividend yield of 5.7% compared with a 10-year average of 7.5%. I actually thought these results were pretty good, and they're significantly better than some of the other house builders that we've seen. I suppose the dates, these are slightly later, and I know with the others there had been that sort of trajectory that was improving. I'm happy holding the house builders. I've got Redrow or Barratt Redrow myself. I think one thing that I would be a little bit more concerned about than perhaps I had been in the last sort of year or so is that I felt that there was a real trajectory and improvement in the numbers coming through from the house builders. I think now that you're seeing inflation sort of creep back up, and maybe from a macroeconomic perspective in the UK, things sort of slowing down, the sort of planning reforms that were promised, are they being delivered? I think those sorts of things are a little bit more worrying now, and we're perhaps not seeing the growth that we would have expected with a more sort of broad and sweeping reforms that were promised under the new government. So I think that would be something that would just temper things a little bit for me. But I think overall, the long-term fundamentals and that structural imbalance between the demand and growing population and obviously a very limited supply, I think all lend themselves to making the house builders a good structural long-term prospects. So I think that's where I am at the moment, and I think the valuation is still pretty cheap.
I would agree. I was also surprised by how good these results were compared to, I think, Taylor Wimpey and Barratt Redrow in particular. I don't know whether it's to do with the geography as well, in that a lot of Persimmon's homes, I think, are more in the southeast, which has maybe helped them be a bit more resilient. But I agree with what you're saying about, I guess, building more homes. I think longer term, I think our position's always been clear on the show that I think there are long-term tailwinds. Whether they're going to be realised under this government or a future one, I think is less clear, but I guess that's more short to medium term anyway. In terms of valuation, I think it's actually all right. I think for below the 10-year average, dividend yield's pretty decent, albeit also below the 10-year average. But I just think as well, it's a pretty reasonable valuation on the back of what I think is a pretty good set of results.
Would it tempt you?
Unfortunately not. So I think although it's a reasonable valuation and a good set of results, I just think, is it high enough up my list, my watch list? It's probably not. It's definitely good enough for the watch list, but I don't think there's other businesses I'd rather own is the issue.
Yeah, no, fair enough. And it's interesting because if you look at the share price over the last 5 years, it's down nearly 60%.
What happened? But if you factor in dividends, I mean,
Yeah,
I know
so
you've not gone over 60%, but you've still done all right. Well, if not, you've probably still lost.
No, absolutely. But I think it's interesting, and I think it probably does reflect some of the longer term market views. But I don't
They've had a
know.
few issues, Persimmon, haven't they? Because they had build quality.
They did. But then some of the others have more issues when it's come to flats and cladding, etc. So I don't know.
I think that with Persimmon, because I think it's a few years now since they've had build quality issues, but I think the 5 years would probably just about include those issues.
That's probably right. But
then if you go back over 10 years,
it is. I think
it's
no, that's right. That's right. So it's interesting, and I think also to a degree, what you think is going to happen with interest rates. Because I think it was looking that yes, they're probably going to be higher longer term than I say historically over the last 15 years that we've got used to. But now, are they going to be coming down even more slowly, particularly given that inflation is rising?
Well, you could also take the flip side that the last 15 years were an anomaly and what we've got are normal interest rates.
Well, you could do. I suppose when we're looking at it, and when we're looking at the house builders particularly, a lot of what you're baking in is kind of post 2008, isn't it?
A very millennial view of the world.
Well, it is, but it is. I think that's right. And also, you've had Help to Buy too. I think it skews how you look at some of the house builders and probably what the norms that you've assumed are.
Should we move on to Aviva?
How are they doing?
I'd say interesting since the last time we covered it. So Aviva have come out with their first half results and operating profit was up 22% to 1.1 billion, with growth generally being driven by general insurance and specifically in the UK and Ireland. General insurance premiums rose 7%, with net flows into the wealth businesses up 16%. Health insurance saw 14% growth in premiums and retirement sales dropped 3%. The board announced an interim dividend up 10% of 13.1p, and the group is targeting operating profit of 2 billion by 2026 with a dividend policy set for mid-single digit growth. They completed the acquisition of Direct Line in July, and the shares were up 4% following the results. They have stopped doing buybacks, but that's probably just for a year because of that Direct Line acquisition. And the annuity business has been growing rapidly. I think that's probably partly been driven by, it might have been given a boost by IHT, which we have talked about in the past. I don't know what business it was in relation to Legal and General, that was it. Just to go into it a bit more, they purchased Direct Line completed in July, as mentioned. That deal was about 3.7 billion, and that put it at a PE ratio of about 12, which I think is pretty reasonable for quite a high quality business. I think they did quite well to get it at that valuation. In terms of Aviva's own valuation, it has a forward PE of 12, and that compares to a 10-year average of 7. The prospective yield is 6.1%, and the 10-year average is 8.7. As well, with that forward PE of 12, if you were to take that 2026 target operating profit of 2 billion, that would put it at 10 times the target operating profit for next year. So again, I think the valuation is pretty reasonable. I don't think it's super cheap, but I also don't think it's super pricey. I think Direct Line's a good acquisition, and I think it's quite a nicely diversified business now because it's got a very strong insurance business. It's also got the pension side and the annuities, and it's got the wealth business as well. And I'm not sure where the future growth is going to come from, other than kind of maybe a bit of a tailwind for the annuity side. But at a forward P of 12 and a decent dividend yield, I think you could do a lot worse. And I think if I was maybe at a different stage of my investing career where I was investing for high quality income stocks, I think at a prospective yield of 6.1%, I think it's pretty attractive, actually. What do you think, John?
Yeah, no, I would agree. I think as a dividend investment or dividend play, it's pretty top quality, actually, and probably one of the best run insurance companies on the FTSE 100. I suppose if you were to make an argument, well, where would sort of future growth come from? Maybe you'd actually be looking more at your Prudential, which is also listed on the FTSE 100, and that tilt is very much Asia. and selling exactly these products, but in more of a growth market. Although going back for the last 10 years, it hasn't really done very well. This is Prudential, hasn't really done very well there. And Aviva's actually massively sort of outperformed, even though its focus is on developed markets. I think the point you make about the annuity business is very interesting. I think you've seen, as you've had higher interest rates, all of a sudden annuities have the return on the annuities, and what you can get, what you can buy, is much more attractive. And I think even more recently, with the last budget, how the pensions are now going to be taxed, annuities are going to be even more popular. So I think that's something that, again, post 2008, things have changed a lot, kind of the last 2-3 years from that perspective. And a business that had not gone out but had become much, much less popular is now back in vogue, really.
Should we stick with our insurance theme then?
Yes. I know we both get quite excited about insurance companies. Admiral Group, so they had their half-year results out last week, with half-year turnover flat at £3.1 billion. Growth in household insurance was offset with reduced UK motor turnover as insurance prices fell. Profit before tax rose 69% to £521 million, driven by strong performance in the UK insurance, as margins for motor plans improved significantly. The group has agreed to sell US motor insurance business Elephant to JC Flowers and Company, and the transaction is subjected to regulatory approval and is expected to close towards the end of the year. The total interim dividend was up 62% to 115 pence a share, made up of a normal dividend of 85.9 pence and 29.1 pence as a special dividend. Including the proposed dividends, their solvency ratio, which measures the balance sheet strength, fell from 198 to 194%, and the shares were up nearly 4% in early trading. In terms of valuation, the group have a market cap of $10.5 billion and trade at 14.5 times forward earnings, compared with a 10-year average of 17, and they have a prospective dividend yield of 6.2%. Again, I don't think these results were very exciting. Turnover was flat. They do operationally seem to be performing fairly well. From what I've read, it seems to make sense selling the Elephant business. But again, I think, not a huge amount to comment on. It's not a business that I would get excited about. It seems to be fairly mature, arguably a lot of the growth behind it. So it's not one that I would really dig any deeper into. I think probably if you were to look at more of a mature dividend play, I would be more inclined to go with Aviva that we've just covered. And if I were to sort of want a more insurance sort of tilt to growth, I'd probably go for Prudential. So it doesn't leave that much room for Admiral. Sam, what are your thoughts?
I think the results were okay, but it's more just the way the general insurance market has been. I don't think there's anything that unique to what Admiral are doing that's really been particularly shrewd. I'd rather own Aviva because I just think you get a better diversified, I think a high quality company, whereas Admiral's just another kind of standalone insurance business. And I think the issue with that standalone insurance business is that people do generally just compete based on price. So it's not the most attractive industry, whereas I think with Aviva having those extra bits in the business, it does just make it more attractive. The dividend yields are pretty similar, and actually Aviva, which I think is a higher quality business, is cheaper anyway. So yeah, I just never really look at it. I'd be much more nervous as well about owning a standalone insurer, just because, as we've commented previously, there's leverage ratios and all kinds of extra ratios and stuff, and all these extra things you need to know about that I just don't. So I'm not very comfortable. Whereas at least with Aviva, it's part of a bigger business. So it would make it for me much more attractive because I would just feel much more comfortable owning a standalone insurer.
Fine. Now, a debut on the show.
Yes, so this is quite an interesting company, actually. So I don't know when it was named, but I think it was quite a while ago because it's called Diversified Energy Company. I'd kind of assumed that would involve some renewables, but it seems to be very much fossil fuels. So I think in today's world, maybe it wouldn't be considered that diversified, although in terms of the investment returns, it's probably not a terrible thing. But this is just straight from their website for what they do. So they say, we focus on acquiring existing long life, low decline producing wells and at times their associated midstream assets, and then efficiently managing the assets to improve or restore production, reduce unit operating costs, reduce emissions, and generate consistent free cash flow before safely and permanently retiring those assets at the end of their producing lives. So they basically just buy old oil wells and just see how much more oil they can get out of them before they run out. So quite an interesting business. So they are actually a US business, but they listed on the FTSE originally. They have since, in the last few years, they've got a dual listing now in America as well. I do wonder if at some point this does look like a contender to leave the FTSE, given we've had a bit of an outflow and it's already an American company. I don't really know why they listed in the UK in the first place, so it would seem quite a sensible thing to do. So, Diversified Energy Company have come out with their half-year results, and total production was up 34%, and of that, natural gas was up 22%, NGLs, I need to check what NGLs are again now. I did check last night and I've forgotten. It's natural gas liquids. So total production was up 34%. Of that, natural gas was up 22%, natural gas liquids was up 38%, and oil was up 328%. That's production, by the way, not revenue. The percentage of natural gas as a proportion of overall production has dropped from 84 to 77%. And the average realised sales price is up 63%, with natural gas up 70%, natural gas liquids up 3%, and oil down 16%. Total revenue was up 120% to $737 million, and all these figures are in dollars. Of that, natural gas was up 108% to $435 million. Natural gas liquids was up 42% to $101 million, and oil was up 260% to $202 million. They did have some quite significant losses on derivative settlements, and that has taken the net income position to a loss of $34 million. However, the operating profit was $133 million, and the adjusted EBITDA was $418 million. Although it does have quite a lot of debt, so that it's also got quite a lot of depreciation as well. So that adjusted EBITDA figure should be taken with a huge pinch of salt. Interestingly, it's actually got negative retained earnings, which is quite unusual. That's mainly just because I don't think it had very huge retained earnings because it was quite a big dividend payer, and then it had a big loss last year. One thing I've not spent loads of time looking at it. Well, I did spend a bit of time, but I couldn't find the answer. My understanding was that companies with negative reserves couldn't legally pay dividends. However, they've continued to pay them. I suppose the answer, actually, now that I've said it out loud, is it might be different rules in America because it's an American company. But in the UK, I wouldn't expect them to pay a dividend, although it being a bit, maybe there's something I don't know, but I wouldn't have expected them to pay dividends, and they've continued doing that with negative reserves, which is very, very unusual. For anyone who's not an accountant, that's probably not a very interesting comment. But anyway, as mentioned, net income position was a loss on a statutory basis. And when you look at how they've gone from net income to adjusted EBITDA, there's a lot of finance costs, there's a lot of depreciation, and then you've also got the derivatives, which we talked about earlier, and that is really the bulk of it. In terms of the valuation, there's not currently earnings because of those net income losses. However, it is trading at 8.2x free cash flow, which is maybe a better indicator. And it's currently got a dividend yield of 7.29%. And it looks like consistently it has been a big dividend payer. I actually think this is a really interesting business because it would be quite a good play on LNG and natural gas, which I think in the last couple of years has had a bit of a revival. I do also wonder if some of these older wells, we saw obviously the news with Norway in the North Sea the other day where they had a well that was thought to be basically depleted, and they've got now, like another 100 million barrels or something like that that's going to come from it. So a lot of these old wells, actually, you do wonder how much some of them could be worth and what they're actually sat on there in terms of the assets. but the results have been pretty poor recently. It's continued to pay a high dividend. It's got a fair bit of debt. And it's just, there's a few things in there that just look, to me, I wouldn't necessarily say irregular, but a bit difficult to understand. So I think it probably just goes into the too hard pile. But I think if it had a few years of more consistent, easy to understand results, it would have been quite an interesting business if you wanted to play, more of a pure kind of fossil fuel play. But yeah, it's interesting to look at it, but I don't think it's something I'd be that interested in coming back to. What about you, John?
Yeah, I think for me, it would go into the too hard pile because I think a lot of it is focused on, the wells and whether they kind of get lucky in terms of how much they think they're going to get out of them. Obviously, price could be volatile too, but with those two things combined, unless I had some sort of industry knowledge, I'd probably just stay clear of it.
Should we move on to another industry that you'd probably just stay clear of?
Yeah. Well, TUI, we've covered it quite a few times on the show. I was going to say it's sort of most famously, I think, travel agent, but it's airlines, cruise ships, and famously the sort of package holidays and what used to be on sort of every high street in terms of the travel agent. Anyway, they had their third quarter results out with revenue up 7% to 6.2 billion euros, beating estimates, supported by increased volumes and higher prices. Underlying operating profit rose by 38% to 321 million euros against 268 million euros expected, driven by strong performances in the holiday experiences and cruises segments. Underlying free cash outflow for the first 9 months was around £200 million, and net debt improved by 200 million to 1.9 billion euros. Bookings for the key summer period were down 2%. However, early indicators for winter bookings are showing more positive momentum. Full-year revenue growth is expected to be at the lower end of the 5-10% range, but underlying operating profit guidance has been raised from 7-10% to 9-11%. And shares were up 2.2% in early trading. In terms of valuation, the group have a market cap of 4.4 billion euros and trade at 5.9 forward price to earnings. In terms of the comparison with 10-year, the 10-year average, that's 6.4, so it's below the 10-year average, and it has a prospective dividend yield of 3.6%. Some encouraging signs here, definitely for TUI. For me, though, it's the industry. You've got cruise liners, you've got planes, you've got a hyper-competitive travel agents business competing with online. I think they're all the areas that, for me as an investor, you wouldn't want to be in. I know it's cheap, but I think it's cheap for these reasons. I think competing with online and then the cyclical nature of some of the travel industry, I think the capital costs involved, and then you've got the exposure to commodities, particularly with fuel when it comes to the airlines. They're all things that you're just sort of a hostage to fortune over and beyond the company's control. I think when you see how easy, and this is just my own anecdotal experience, it is to book holidays kind of independently through low-cost websites, it's very difficult to see how a business like TUI is sustained in the longer term. And I don't think it's got any particular niche. You've got some smaller companies, maybe like Trailfinders, for example, where they could create more of a unique experience, and then you would pay for them to do that for you. I don't really see that with TUI. So for me, it's sort of uninvestable and wouldn't go that much further. I mean, it's interesting to dip into every now and again, but yeah, nothing's fundamentally changed for me.
I'd agree. I actually think this is a decent set of results, but it's just in an industry. Well, it's not even just in one in an uninvestable industry. It's actually in multiple uninvestable industries, and I think every industry it's in, I would consider uninvestable. So yeah, it's just not for me. But I think it's a decent set of results, and I do find it interesting to cover the airlines because I think they're quite a good gauge on the general economy a lot of the time.
Yeah,
absolutely.
absolutely.
Should we move on to PayPal then, a business that I own?
How are they doing?
I think they're doing pretty well. The market continues not to agree with me. So they have reported second quarter earnings, and well, this was actually a while ago, but we didn't have time to cover it at the time, so we've gone back to it. And they had net revenue of $8.3 billion, and all these figures are in dollars, which was up 5%, ignoring exchange rate impacts. Total payment volumes rose 5%, with peer-to-peer and other consumer experiencing the fastest growth, up 10%. Underlying operating profit rose 13% to $1.6 billion, and that was driven by a 7% uplift in the transaction margin, which was helped by a shift in the business mix to more profitable branded checkouts and credit. Underlying free cash flow fell from $1.1 billion to 700 million. Net debt was $1.3 billion at the period end, which is absolutely nothing. The company repurchased $1.5 billion of shares during the quarter, and that's on a market cap of $66.93 billion, so that's pretty decent for a quarter. The full year underlying earnings per share guidance was raised from $4.95 to $5.10 up to $5.15 to $5.30, pointing to growth of earnings per share between 11 and 14%. Full year free cash flow of $6 to $7 billion guidance has been reiterated. However, in the third quarter, transaction margin growth is expected to slow to between 3 and 5%. The active accounts also grew 2% to 438 million. And they've highlighted strategic initiatives like PayPal World for cross-border payment solutions and expansion into stablecoins. The shares were down about 8% following the announcement of the results. And in terms of the valuation, it now trades at a forward PE of 14.4, and that compares to a 10-year average of 27. It doesn't pay a dividend, but as previously mentioned, it's buying back a lot. It's usually it's buying back about $5 billion of shares a year, which on a $66 billion market caps, I think it's getting on not quite 10%, but it's not far off. And in terms of free cash flow, it's actually trading at, so I've got it at 12.7x free cash flow. But actually, if we take the guided, we can do forward, can't we? So free cash flow guidance is 6.5 billion, so 6 to 7 billion. So if we take the midpoint of 6.5, again, it's trading about 10 times forward free cash flow. So I think for the quality of the business, I think it's really cheap. I'm quite happy owning my shares, and I'm going to continue to hold. John, as someone who's less biased, what do you think?
Yeah, it's difficult. I was going to put it back to you. Why do you think the market's taking such a different view on it?
I don't know. I suppose it's just those longer term concerns, isn't it? You've got Google Pay, Apple Pay, but they've been around for a while now. And the number of accounts are going up. It's got a lot of different parts of the business. It's got Venmo, it's got Braintree, it's got other, it's got the stable coins it's going into. It's not, if you compare it to what it was when it was spun out from eBay, it does a lot more now.
Yeah.
And obviously the market, I think, is quite forward looking. So it might be it's expecting at some point, revenue is going to start dropping, and it's going to start dropping quite significantly. But so far that hasn't really happened. And I think for the quality of the business and the numbers it's putting up, I do find it odd.
So I think that's probably what I'm just a bit wary of is, I know, again, anecdotal, and it's not, it's sort of an investment case, but most of my transactions will go through Apple Pay, and then that'll be, Visa or MasterCard or American Express. But PayPal, I used to use it quite a lot, and certainly when it was linked with eBay, then again any eBay purchases would go through that. But now it's very rare, and I suppose I'm slightly anxious in terms of the view that the market's taking on that and what it's sort of seeing, about it. Because I appreciate, when you look at the numbers, it doesn't seem that bad, and you think it's, arguably undervalued. But I don't know. I'm probably on the fence with it.
But I've probably owned it, I guess, 2 or 3 years now, I think, and in fairness, I've not had any returns from it. It's about break even. But in those 2 or 3 years, the business has continued to improve.
Yeah.
This drop off hasn't really happened. So I think at some point the multiple is going to re-rate. That's what I think will happen. The multiple has to re-rate, I think, at some point, or the business has to drop off.
Yeah.
It can't continue in 5 years' time if it's continuing to grow at this rate and putting up these kind of numbers. I don't see a scenario where it's still trading at 10 times its free cash flow. But
and I know a lot of the big tech companies had a run up, post pandemic. thinking back to them, Google Pay, Apple Pay, they weren't as big, but they were really coming through. There seems to be a fundamental change, I suppose, there.
It was a weird one, PayPal, because that was included in the COVID run-up, and you could have got it for like 50 times earnings at that point.
Yeah.
And it's down like 80% since then. But
yeah.
I think there was this idea that it was going to become this super app where it's like it would almost become like a Hargreaves Lansdown as well as using it as a wallet. Basically anything to do with money you'd be doing inside this super app. And I think that was kind of what it was based on. And it's obviously not probably not going to become that, but equally, like I say, it is far more than the PayPal that was spun out from eBay originally.
Yeah. No, well, I suppose wait and see. And
it's still one of them where I think as well, like it's been a while since I've topped it up, and I don't think I would top it up anymore. I'm quite happy with the position I've got.
Yeah.
I'll just see how it does, but it's not. I don't think it's one where it's like I'm going to keep buying more of it. I think I've got enough now that I'm happy to just see how it performs.
Yeah, it goes. Yeah. No, fair enough. Okay. Of the companies this week, what would be your top pick and what would be last?
So top pick for me would be quite easy. It would be the one I own, PayPal.
Yes.
If I exclude that on grounds of bias, I think I would probably go with Persimmon.
Yeah.
I think bottom pick would be quite easy. That would be TUI.
Yeah.
What about you?
Yeah, for me, I'd probably play it safer and go for Persimmon as my top pick, and TUI's an easy last.
I think that's everything in that case.
Thank you very much for listening, and we will see you in a couple of weeks.
See you in a couple of weeks.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.